Hey, what's up, my friend? So in today's training, I want to share with you the best stock trading indicators for beginners. So let's get started. The first indicator that I want to share with you is moving average. Why? Two reasons. Moving average allows you to identify the direction of the trend. So this means at any one point in time, you know what to do. Should you be buying in the stock markets or should you be selling? Next, moving average helps you to identify the area of value. So this allows you to buy low and sell high in the stock markets. Make sense? Alright, don't worry if you don't know how to do this right now, because in the later part of the video, I'll share with you step by step how to apply the moving average. But first, I want to talk about the moving average indicator. What is this about, and why does the squiggly little line goes up and down on your chart? So a moving average, in essence, right, it's a trend following indicator. It works best in a trending market. And the value of your moving average is derived by taking the average, right, of the past prices. So when you see your moving average line, goes up, goes down, what it's actually doing is taking into account the average, right, over the last few candles, depending on how many time period moving average you're using. So for example, let's say we go with a 5-period moving average. What it does is that it looks over the last 5 candles and look what is the closing price. Of course, you can use a different price. You can use the opening price, closing, high, low, whatsoever. But in this case, let's just keep it simple, the closing price. So let's say the last 5 candles, the closing price is $1, $2, $3, $4, and $5. And you're using a 5-period moving average. So what is the value of your moving average? And it's very simple. What you're going to do is to add up all these numbers together and divide by 5, because it's a 5-period moving average. So you take 1 plus 2 plus 3 plus 4 plus 5, divide by 5. What are you going to get? You're going to get 3. Okay, so this value is 3. So once you have this value 3, it will be plotted as like a dot on your chart. Okay, I'll explain why later, how it will end up looking like a normal moving average. But for now, let's treat it like a dot on your chart. And let's say the next candle opened and it closed, let's say, at $6. So clearly when this price, when the market is closed at $6 on this candle, the moving average will be updated. So what is it going to do? It's going to look again, right, at the recent 5 most candles. So this is the recent 5 most candles, right, and their respective prices. So it's going to be $2 plus $3 plus $4 plus $5 plus $6 divided by 5. And that will give you your most recent moving average figure, and that will be a 4. Okay, so you're going to take this 4 and again plot it like a dot on your chart. Okay, so you keep doing this for the next, 10, 20 numbers. What's going to happen is that when you connect the dots, right, it will appear like a moving average on your chart. Whether it slopes up higher or whether it slopes down lower depends on the prices, the closing prices, whether is it heading up higher over time or heading down lower over time. And that's kind of like the secret, right, to how moving average goes up and down. So now that you have understood the fundamentals, how do you use it? So first, let's talk about how do you use moving average to identify the direction of the trend. In other words, right, to know what should you be doing. Should I be buying or selling? Very simple. What you want to do is to plot the 200-day moving average on your charts and then look for buying opportunities, right, if the price is above it. So for example, you pull out your chart and let's say the price, goes up, goes down, goes up, goes down, goes up, goes down. What you want to do is to overlay this with a 200-period moving average, which will look something like this. So very simple. If the price is above the 200-day moving average, what you want to be doing is to tell yourself, Rayner. Oh, I sound weird talking to myself, but let's imagine, I'm talking to someone called John, right? John Doe. Hey, John, if the price is above the 200-day moving average, you want to be looking for buying opportunities. Make sense, John? Okay, so in this case, price now is above the 200-day moving average. You should look for buying opportunities. So let me share with you a few charting examples so you know how this looks like. So if you look at this chart over here, all you need to do is, if you're using TradingView, go to indicators and look for moving average. Okay, you can see over here they have exponential, weighted, or the normal one. Honestly, it's not going to make much of a difference. In this case, it's just a normal moving average that I have over here. And you can see that the price now is above the 200-period moving average. This is the current closing price, and this is the 200-period moving average. Since the price is above it, what should you be doing? You should be looking for buying opportunities. That's right. Next one. How about Zoom? If you look at this, the price right now it's at this price point, 200-period moving average is here. What should you be doing? You should be looking for buying opportunities. That's right. And last one, right? Fiverr, again, same thing. Price above the price is here, 200-day moving average is here. What should you be doing? Looking for buying opportunities. That's right. If the price is above the 200-day moving average, look for buying opportunities. If the price is below it, you want to stay in cash. You don't really want to look to short the stock markets because in the long run, it's trending higher. So it's much easier to stay long or remain in cash. Okay, so that's the first technique that I want to share with you. Second one, how else can you use moving average? I mentioned that you can also use it to identify your area of value, because here's the thing. Just because the market is in an uptrend doesn't mean you want to buy immediately, because it could be far away from an area of value. It's kind of like this, just because you met a girl for the first time doesn't mean you're going to marry her. She could be, for the first time, she could be have the face, all full of makeup. You do not know how she looks like underneath the makeup. You bring her home and you get, you get shocked, right? Or how about, you meet a girl for the first time, it could be a transgender, it could be a psychopath, or whatsoever. So this is why it's the same as trading. Just because the market is in an uptrend doesn't mean you want to hit the buy button just like that. No. You want to let the price come to you, come to your area of value. Just like, relationship, right? You want to make the girl work hard to get you, to come to you instead. Usually, when that happens, you have a much better chance of success. Okay, so same thing here for trading. When you use moving average, when you're looking to buy in an uptrend, trade it from an area of value, not far away from it. So now, how do you do that? So very simple. What I like to do is to use the 50-day moving average because it tends to act as an area of value in a healthy trend. So let's say price is heading up higher, we trace higher, we trace higher, we trace. So what I want to see is the 50-day moving average, right? The price respecting it once, twice. So this way, right, when I see the price bounce off the 50-day moving average a number of times, right, I know that it's acting as an area of value. And this is where, it's the best, kind of like the best time, right, for me to enter a trade. So let me just share with you some charts so you can see what I mean. So if you look at Fiverr, you can see that this market, it's in an uptrend. But just because it's in an uptrend, it doesn't mean that you want to buy immediately. So what you can do is, again, you've seen earlier, price above the 200-day moving average. We should only look for buying opportunities. But we don't want to be buying at these highs. So where you want to buy instead is, again, just overlay with the 50-period moving average. And now things are much clearer. You notice that this market seems to be respecting the 50-day moving average. This is an area of value. Over here, this black, this thing that I've shaded over here. Okay, so this means, right, you want the market to retrace back down into this area of value, and then you look for buying opportunities. Right, this, right, will give you a much favorable risk to reward on your trade. Okay, another example. If you look at Kirkland, same thing. Do you want to be buying this stock at this highs over here? Well, you could, right? But a much better option is to let it come to an area of value. And again, the 50-day moving average serves as an area of value. Notice how it tested a number of times. Once, twice, thrice, almost fourth time. And here, there's a good chance it could find potential buying pressure at this area of value. Okay, one last example. CVNA. And this one I want to point out is that when you look at area of value on your chart, it's not a level, it's not a fixed price point, it's an area. So you can see that over here in this case, the price did, whipsaw around this area of value quite a bit because it's an area. So I want you to treat this as an area on your chart, not a fixed price point level. It's an area of value. And this is where you want to look for buying opportunities in an uptrend. And that's what moving average can do for you. Second indicator that I want to share with you is the average true range indicator. Okay, why is that? And it's very simple, because average true range indicator, it helps you set a proper stop loss so you don't get stopped out of your trades too early. So for example, I'm not sure if this has happened to you before, where you buy at support, then what happens is that the market bounce up higher, dips down back below support, hit your stop loss, you get stopped out here, one big cross, and then it rallies higher. Has it happened to you before? If it does, right, then you probably want to use this average true range indicator, right, to prevent this from happening. So let me just share with you an example over here. So you see over here, this stock, right, TRIL. Many traders will look at this, right? Oh, Rayner, look at how bullish this stock is. It's in an uptrend, Rayner. It came into this area of support. Then we have this green bullish close. Time to buy. Let's buy, Rayner. And then you buy on the next candle open. And where do they set their stop loss? Oh, Rayner, the textbook says you should set your stop loss below the lows of the candle. So you set it here. What happens? Market seems to know your intention, seems to know where you put your stop loss. Next thing you know is that it triggers your stop and then rally higher. So how can you prevent this? How can you avoid this? And it's not difficult really. The average true range indicator, right, can help you with it. And here's how. Let me share with you. So before we get started, average true range is in essence, right, a volatility-based indicator. Its value is derived by taking into account the range of the historical candle. So instead of, looking at the prices like the moving average, what it does is that it looks at the range of the past candle, whether the range is tight, whether is it big, small. Okay, so that's what it does. So how do you use this indicator? First and foremost, you want to identify the price structure. This could be something like a swing low, could be support, it could be moving average, could be a trend line, etc. This is basically, right, an area of value, right? This is what I mean by the price structure, the area of value that you are trading from. Number two, you want to set your stop loss 1 ATR below it, and it's very simple. Let me just share with you how this works. So let's say you're trying to buy at support. Okay, so what you want to do is to identify the price structure. So in this case, it's support. Next thing you want to do is to set your stop loss 1 ATR below it. So what you're going to do is to pull out your ATR indicator, find out what's the value, right, and then minus it from the lows of support. So let's say the lows of support, the value is X. Your 1 ATR value is Y. Okay, so just take X, which is the lows of support, minus Y, and let's say it's Z. Algebra, I don't understand, Rayner, my head is hurting. Don't worry, let me give you an example. Okay, so again, let's have a look at this one here. This Trillium Therapeutic example. So what I'm going to do is I'm going to pull out the average true range indicator. Okay, I use 20 period because there's 20 trading days in a month, and I use SMA just to, be consistent, keep things simple. So you can see that right now, the average true range is about $1.59. I'm going to keep things simple and make it rounded up to $1.60, as you can see over here. Okay, so now when the candle closed bullishly higher, what I'm going to do is to find out what's the lows of this price point, because this is the lowest low at support. Okay, so let's say this lowest low is currently trading at about $11.61 as shown on TradingView. So what I'm going to do is to take $11.61 minus $1 and let's do the 59 cents to make my life harder. So what you're going to do is that if my math, right, serves me right, the answer should be $10.02. Trust me, I'm not good in math. I'm just doing my math right now live as I am in front of this screen. It should be $10.02. So your stop loss should be at that level. So I'm going to pull out the horizontal line. This one should be at $10.02. 2 cents. Okay. So this, right, let me just walk you through. From here, this low to this pink line over here is in essence 1 ATR. And 1 ATR, the value is defined as is shown over here, $1.59. So what this tells you is that the historical volatility of this market over the last 20 days, over the last 20 candles, is about $1.59. This market moves an average of $1.59 a day based on looking over the last 20-day prices. So let's give this market, or rather give your trade some room to breathe, right, based on this recent volatility. So that's how you set your stop loss. And if you do that, right, on hindsight, clearly you wouldn't have gotten stopped out. Okay? So this is how you use the moving average in your trading, right? So this is pretty much it, right? Identify the price structure, identify the area of value that you're trading from, and then set your stop loss 1 ATR below it. Some traders want to be more conservative. You can use 1.5 ATR or 2 ATR. Some want to be, having a tighter stop loss. You can use 0.5 ATR. It's entirely up to you, right? For me personally, I use 1 ATR below the area of value. The third and final indicator I want to share with you is the rate of change indicator. Why? Because it helps you to filter down the best stocks to trade. Because when you're trading stocks, let's say the US stock markets, there are like thousands of stocks out there. And often you're going to find two similar trading setup happening at the same time, and you wonder to yourself, man, which ones should I choose? It's like, let's say two girls, right, like you at the same time, and you have feelings for both girls, but you do not know which one to choose. I'm pretty sure you would choose one over the other based on a certain criteria that you have. Maybe one is meatier than the other, one is more intelligent, one is smarter, one dressed better. I don't know what's your criteria, that's your preference, but you basically have a ranking criteria. Okay, but I guess a smart one would basically choose both girls and date them both. But anyway, you have a ranking criteria, and it's the same for trading, right? You have to have a ranking criteria to favor one stock over the other, even though they might have similar chart patterns that you're about to trade. So that is what the rate of change indicator can help you with. So in essence, right, this indicator, the rate of change, is a momentum-based indicator. It measures the percentage change in price. So let me show you how to use this indicator to find or rather to filter down the best stocks to trade. And it's very simple. What you want to do is to filter stocks according to their 50 weeks rate of change. In essence, right, you want to ask yourself, right, I'll just show it to you later, right? Filter stocks according to their 50 weeks ROC, and then focus on buying higher ROC value stocks. So for example, let me just share with you here. If you look at the charts over here, let's say you have two similar trading setup. So let's say one is called Kirkland, right? It looks like a price is at this swing low looking to bounce higher. Okay, you look at this green candle. Then maybe you have another one that is CVNA that looks something like, let's say like this, okay? Again, similar setup, price is at this swing low looking to bounce higher. So which one do you choose? Do you choose CVNA or do you choose Kirkland? You might be spoiled for choice. Or sometimes you might even have 5 or 10 stocks which are behaving similarly. So what you want to do is to pull out your ROC indicator. Just going to pull out ROC, rate of change, click on this. I like to use the weekly time frame to reference it over the last 50 weeks. So in essence, right, what this tool does, this indicator, this 50-week ROC indicator does, is that it tells you, right, over the last 50 weeks, right, how much did this stock gain in price? How many percent did it gain in price? So if you look at this, right, for CVNA, it has gained 163% over the last 50 weeks. Okay, cool. Now let's compare that with Kirkland. So for Kirkland, at that point in time, it has gained 384%. Big difference, right? Kirkland is much stronger in terms of ROC value. So with that in mind, what we're going to do is that, what I'm going to do is that I'll favor buying Kirkland over CVNA. That's how you use the ROC indicator to kind of, filter for the best higher probability trading setup. And the reason for this is quite simple. It's because in the stock market, it's proven academically, right, that strong momentum stocks, or rather stocks that have performed well over the last 6 to 12 months, they tend to continue to outperform the market. Okay, so this is why we are using this ROC tool to help us filter out which stocks, right, are the stronger performing ones, and we are going to favor those stocks, right, over other stocks which are not as strong or have a lower ROC value. We don't want those stocks. We only focus on stocks which have the highest or the higher ROC values. Okay, so that's how you do or use the ROC indicator. And one thing to point out is that you want to avoid stocks, right, that are trending down lower. When stocks are trending down lower, their ROC value will probably be negative. Avoid those stocks because they are in a downtrend. Only focus on the strongest, highest ROC value stocks. These are the stocks which are the strongest and have the strongest momentum. And it's the same for relationships. You want to avoid girls that have, horrible past or, cheating on boyfriends and stuff like that. It's not going to end well. So same for stock trading. Focus on the best ones, the strongest ones, right? Those with the best track record. So with that said, right, let's do a quick recap to what we have discussed today. Number one, the best stock trading indicators that I recommend is moving average. Why? Because it helps you to identify the direction of the trend and to help you identify the area of value. Next one, we talk about average true range indicator, how you can use it to set a proper stop loss so you don't get stopped out of your trades too early. And finally, we spoke about the rate of change indicator to help you filter down, right, for the best stocks you should focus on. And by the way, if you've enjoyed, such training on stock trading, then go down to this website, shootingstocks.com. It's my website over here, right, where I focus more on stock trading, and click on this orange button to download this Shooting Stocks Trading Strategy Guide. I'll share with you a simple trading strategy to profit from the stock markets, how to ride massive trends, and much, much more. So go ahead, download this guide. It's free, and I will talk to you soon.